It's time for another stock review. This time it's Fisker, ticker symbol FSR. Now, this is the first time I've looked at this stock, so I'm reviewing it in real time live with you. And this will be on my channel, Martyn Lucas Investor. And also, if you're watching me today on Alpha Spread, the #1 platform for reviewing stocks. And I appreciate you watching me here as well. Wonderful platform. And if you watch to the end, I'll give you a link and you can get the premium service for Alpha Spread. And with my discount code, which gives you 10% discount. And if you use my code as one of my YouTube members, it basically gives you my membership for free. Pretty cool, right? Let's get into Fisker. We're going to do a back test on it. We're going to look at a price targets, Wall Street analysis targets. We're going to look at the inside trading, who's buying it on the inside, who's selling it. Look at the balance sheet, the full intrinsic value, a brief look at the website, a back test, comparing it to the S&P 500. We're going to give it a really good look at, should we invest in Fisker? What is Fisker? All right, let's get straight into it. And the full disclosure, this is not financial advice. This is just my opinion. And I'm doing an analysis for my channel and Alpha Spread and sharing my opinion with the facts, just as they are here for Fisker. Right, let's go straight into it. Start with a nice basic overlook, and then we'll go deeper and deeper into this video. So if you follow me through the video, it'll get deeper and deeper with more information as we go. We're just going to start now and look very, very quickly at what is Fisker. Fisker engages in building technology, a technology-enabled automotive business model, which, let me just zoom that in a little bit, make it a bit clearer. This is very small writing, but we'll do our best we can, which involves vehicle development, customer experience, and sales and service. It also designs, develops, and manufactures eco-friendly electric vehicles. Let's just open it up a bit more. The company was founded by Henrik Fisker, makes sense, and Geeta Gupta-Fisker in 2016 and is headquartered in California. The listed name, of course, is FSR. Now then, as we mentioned, the CEO is Henrik Fisker, 760 employees. So it's a small company. It's been around since 2016. It's a new company again, as we said. And now, first of all, you want to look at, if you were buying this with margin, it's got a 60% maintenance margin requirement, which means it's regarded as quite risky. 25% is the lowest, 100% is the highest. So it is regarded as quite risky. It's not a dividend-paying stock. It's simply a growth stock. In the EV sector, average volume is 11.13 million, and the volume is 1.4 million today at making of this video. Currently, it's losing money. It's negative $2.32 price earnings ratio. We want to look at that, but remember, don't always compare that within itself. You must compare it to other EV companies, and of course, new companies that start off, startups and so on, are capital investing into themselves. They are spending more than they're earning. Obviously, every business is like that. So when a business is new, it can be losing money from the from the get-go. Not always, but it can be, and it can be a good or bad thing. All right, the low today is 375. The 52-week low is 368. The 52-week high is 885. So we have had some swings there. So market cap of 1.3 billion. The analysis here, this is not my rating. We'll come on to my thoughts later. But right now, the analysts from Morningstar give it a 42% rating. We always need to remember, though, is if you are looking at this, when was it done? A lot of these services don't update regularly, so you need to go a little bit more into it and see when it was done. We'll come to that in a second. Now then, earnings. As you can see, we started in Q4 22, started to rise, missing earnings, but Q2 23, we beat earnings for the second time it looks in its most recent history anyway. But we are moving in the right direction. The analysts, and remember, this is the analysts, have given it a higher expectation, which is nearly turning profitable. I think that's a little bit early for an EV company of this size. But however, it looks like analysts think it may nearly turn profitable on the next earnings. Very close, as you can see. Across there. However, that's only their review, their thoughts, not the company's. Remember that. That's only their thoughts. We'll see if they beat, and that is after hours today. And sadly, we can't cover the earnings today. We are covering Rumble and FFIE, other EV company, but we can't do everything, right? Anyway, let's scroll down and look at who is investing in this company. This is very, very important because it gives you the sentiment of the stock, tells you the sort of people that are investing in it and what the volatility is likely to be. Bad news straight away, folks. Lucid, one of the best EVs in the world, if not the best EV, but the worst run company in the world. I don't know how it's allowed to be legal, but Peter Rawlinson, the CEO, takes away $500 million a year in wages into himself, while the company loses $500,000 every time he sells a car. I don't know how he looks himself in the mirror, but he does. He must be laughing all the way to the bank. Well, he's laughing all the way to private ship. The company will be going private. The shareholders are getting nothing. That's the same people that invest in Fisker. That's a worry because it's very passionate people who are very aggressive about stocks. I know. I deal with all the comments. I know the sort of people that buy, short, how they feel about it. I don't like the fact that Lucid investors are in Fisker. That tells me there's volatility and the wrong type of investor. Don't like that. Don't know much about Nikola, to be honest, or Workhorse. NIO, Chinese stocks. I don't like Chinese stocks. Too much manipulation. Hence what I just said with Lucid, even though Lucid isn't a Chinese stock. And Zenping, I don't know much about that one, so I can't comment. All right, so there we go. There's the basic first look. Let's now go and look at their website. Have a quick look at their website and see what we have over here. On their website, all electric, dynamic, driver-centric. Let's scroll down and have a look at the car. You can see what the car looks like. Range up to 360 miles. We're not going to get into the details of the company. I'm just giving you the headlines for it so you can go and take a better look at Fisker or what it's all about. But there you go. That's look, I tell you what it does look like straight away. I don't know if you agree with me or not. This looks like a very, very, very low budget website. Very low budget website. Is that important? You're damn right it's important. Doesn't look like Tesla, does it? This is a very, very low budget website. My website looks better than this and I do it myself. So is that important? It is. In fact, it's a reflection of the company and you're trying to get people to invest in your company. This is terrible. The way they've laid this out looks like they did it on their mobile device. That's terrible. I have to say that's probably one of the worst publicly traded companies' websites I've ever seen. And we're here to review a stock. We're here to look at the company and see how it looks. Right, at the end of the day. Right. Let's now go over to our more detail on the stock. We're going to look at this now. We use Alpha Spread. As I said before, this is probably the best service we have found and software that we use in conjunction with our software. We are partnered with Alpha Spread. And if you wait to the end of the video, I'm going to give you a link to this service. And if you're one of my members and you use our referral code, you will get a discount so big it makes our membership for free, which is phenomenal, okay? 10% discount. However, if you're not a member of our channel, and that's fine, we can give you a referral link to this service and you will get just the normal price, but you can always upgrade with our link and become a member and get our membership for free. Let's have a look now then. Intrinsic value. Intrinsic value is everything. People say, well, growth stocks, they are always overpriced. Like Tesla, for example, the stock will grow into it. Well, yes, but then what happened when Elon Musk dumped his stocks? The stocks were supposed to be at $2,000 or whatever it was, and then they came all the way back down. And again, we had the reverse split, the forward split, and so on, and the stock devalued massively over a year. I think it was down like sort of 50, 70%. That's the point of buying value. It doesn't matter how good a company is. Yes, it could grow into it, but it can always drop. And if you end up paying any price, you could be locked in a stock forever. There's no point doing that. Always do your research. It requires discipline and service, but that's why I provide these videos, so you can find all the information in one place. We're not here to promote the stock. We're not here to pat it on the back. We're here just to tell it how it is and whatever. So the best way of reviewing a stock is its intrinsic value. If the best case scenario was played out, everything in the world was great, interest rates were low, everyone was buying cars, everything was good, FSR was doing a great job building a better website. Well, I mean, honestly, it's important. It would be undervalued by 100%. The world isn't like that, and that's not how it is. Intrinsic value, they're giving it $475, and we're going to come into how it's valued like this shortly. Undervalue, worst case, $305.95. So you can see, going through our software, looking at the margins, the cash balances, the profitability, all of those things, solvency, that's where these scores come from. These aren't random scores. So the intrinsic value looks like Fisker is incredibly undervalued. Great. Good sign so far. I'm all in. I'm buying it. Brilliant. Give me the checkbook. Right. Wall Street target gives 135% upswing from here. Relative value, 99% undervalued. Great. DCF value down 9%. Intrinsic value, 99%, as we've said there. Exceptional growth, 2,346. This is looking really great so far. It's looking like a gift, right? Okay. Historical profit. Possible value trap detected. This is what it's about. Let me explain what this means. So you look at the intrinsic value or other software that doesn't give this detail, like Robinhood just goes, hey, it's great value. You're buying it without knowing this. It's a possible value trap. A value trap occurs when a stock appears inexpensive based on fundamental analysis, but fails on reach its intrinsic valuation over time, often due to underlying issues not reflected in quantitative data. Scrutiny beyond numbers, assess long-term potential. Scrutinize beyond numbers, assess long-term potential. Right, so what that's saying is, looking at the numbers that you can run through software, it appears undervalued. Looking at the margins, the profits, this and that and the other, it looks great. However, you've got to look at the bigger picture, hence why we're doing this review, hence why we're being critical of the website. I'm just using that as an example. We're not here to join a fan club. We're here to invest and win and make money. That's it, period. No one pays me for their opinions. These are my own opinions, right? Historical profit down 74%. Historical profit. It's not been around for a long time. However, that's there nevertheless. All right, let's move on down. Fundamental analysis. This is important. Profit up 154%. 1.3 million, where we've seen this on other car companies. We've seen companies like FFIE, who we are reporting on tonight. Awful company, do an awful job. That clearly don't want to sell cars. They've even said it on the earnings. Why you need to do your research, why I listen to all the earnings. The CEO even said, we're not trying to sell cars right now. And I'm going, what? I'm a shareholder. I want you to sell cars and make money, otherwise why am I here? They said we're trying to build a brand. Now, building a brand is great, but building a brand is very dangerous. You have to sell stuff. If you ever hear, like, on the Shark Tank or Dragon's Den in England, they always talk about, it's great having an idea, it's great having a great invention, it's great having a good business, but you're not a good business unless you can sell anything. Are you selling stuff, making money? Otherwise, as an investor, I'm never going to get my money out. It might be the greatest car, the greatest idea, but I'm giving you my money. I want a return on it. And if I'm giving you my money, I don't care about great ideas. I care about whether you're selling something. And, so that's what we could be talking at here. 1.3 million revenue, which is nothing. So they could make 1.3 million by making a couple of cars and selling a couple of cars, right? I mean, it could, right? It's nothing. It's up 154%. So it sounds great, up 154%. Well, when you start out, you've only got to sell a toothbrush for $2 and you've made $2. I've made, 2,000%, from nothing. So we've got to be careful about that. Operating income is down 527.9 million. Net income's down 522 million. So we're losing money. We're bringing in hardly anything, and we're spending a lot of money as well. Cash flow down 408.9 million. Let's look at the balance sheet. And the balance sheet is everything. If you've got a really good balance sheet, in other words, you've got a lot more assets than you've got liabilities, then you've got a runway. It's called a margin, a runway. It gives you a period of time where you can operate without going, insolvent, without going bankrupt. Basically, you've got assets to sell or assets to prop up the company. They have assets of 1.7 billion. Right, it's a small company, whatever, but liabilities is 1.3 billion. They're not that far behind. There's not much of a moat here. There's not much of a difference between the assets and the liabilities. And if we look at the liabilities, what we're looking at is long-term debt, 662 million. They've got a bit of debt there. All right. Okay. Scrolling down, gross margins. Now, gross margins in the EV sector, we know, we study Tesla has the greatest margins of any of the EV companies. So it can crush startups like this because it can reduce its price of its cars because it makes money in other things. Tesla will make money in full self-drive, for example. They could sell their cars for a loss. If they wanted to, they could give the cars away if they wanted to, and make it on full self-drive and licensing, all right, to other companies. However, so basically, if you've got a 23% margin, it's not too bad. In the car business, it's pretty good. However, that can be very easily crushed. We've seen higher margins with Tesla. Admittedly, Tesla margins are coming down now, but that's a concern. The margin isn't that wide. It can be reduced very quickly and crushed, and then this company is in trouble. Operating margin, you can see for yourself, 155,000 and 42% down. Net margin, 160,000. I mean, these numbers are huge because they're a startup and everything's just exaggerated at the beginning. Let's look at this, though. This is what the margin was all about. The profitability score is in the red, declining return on equity. Decline on return of equity. That's going down. That's not good. The company aren't making money. Eventually, they can run out of money. They've got some moat, but not much. Some runway, but not much. We saw the margins. We saw the debt relationship to the assets and liabilities. The profitability score, 22. It's in the red. Not good. It's not the worst I've seen, but not good. Solvency score. Solvency score, 30. They're not going bankrupt today, and it's amber. It's not too bad. We've seen worse. We've seen a lot better. We've seen up to about 98. Green, things like Amazon and Apple and stuff like that. Solvency score 30, not great, not good, not bad, not too bad, but they're not going bankrupt tomorrow, but they might go bankrupt in a year. I need to do the precise numbers to work out the run rate, but that's not what we want to see. Now, this is where we talk about the trap of the undervalue. You look at it on the fundamentals and you go, okay, the Wall Street are going 420% upswing, 135% upswing, or 5% in a worst case scenario. So it sounds cheap, but is the company really cheap? Well, we've seen Mullen, disastrous. On paper, they might be massively undervalued. I don't know. I've not done a review, but I'd probably guess they would be. But we know how bad they are. It's very, very easy to invent a car. I say that, I can't invent a car, but the hard part is to ramp it up. Can they ramp it up? That's the difficult part. Can they beat the competition? Can they beat Tesla? I don't know. Anyway, if we look at the landscape and look at the competition, Tesla is there, and you can go through if you want to. You can click on all these if you use our link, and you can go through and look at the competition. All right, now then, ownership. This is important. Ownership. This tells us the insiders who are buying and selling the stock. Are they buying and selling their own stock? Well, we want to know that, right? So FSR. There hasn't been any selling going on since March 28, 2023. A long time. And it was a bit of buying and selling, so it doesn't really tell us a great deal. There's been no inside trading since then. Good or bad. So nothing to really say about that. No one's been selling, no one's been dumping. No one's been buying, nothing going on really. The last transaction was made March 28th by Henrik Jr., who is the Chief Technology Officer, who sold $61,000 worth of FSR shares. Great. Great. But that was back in March. Nothing major about that. Not a lot of shares. Again, if a company is selling a percent or two of their shares, it's not an issue. It's when they're selling 80, 90% of it. Like last week, we reported on Google, a director sold 78%. That's of a concern. Okay, there we go. Now we can look at some news right now. Let's have a little look. We've got some news here, which was September the 26th. I don't know if that news is really relevant. No, it's old. If it had been newer, I would have played it for you, but it's not. Let's look finally at sentiment, right? Sentiment on the stock. This gives an indication of where the stock's going, all right? Over the last 90 days, the sentiment was relatively positive. 43% was positive, 24% negative. The last 30 days, positive energy has gone away and we're all negative now, 48%. Over the last 7 days, we've gained a little bit, but we're still very negative. And today, it's all green, only one positive news out today. All right, so like to look over the last 30 days, it's quite negative. And we can look at some headlines. 3 weeks ago, Fisker had announced a price reduction for the Fisker Ocean Extreme trim, lowering it by 10,000 Canadian dollars and 7,500 in the US. This move comes as Fisker tries to address a slowdown in electric demand and compete with Tesla's price cuts. That's exactly what I spoke about earlier. They can't do it. They can't do it. So they're reducing prices, which means they're not selling. Tesla reduced prices to crush the competition. Now, Elon Musk will say it's got nothing to do with crushing the competition. I'm not so sure I agree with that, because the thing is, Tesla can make money elsewhere. Anyway, so there we go. Now what we need to do is we need to do our final bit of analysis, okay? It's giving you an idea whether you like the stock, whether you should buy it. Now we're going to look at the backtest. The backtest is when you compare a stock to another stock. And we like to use the S&P 500 because at the end of the day, I'm not joining a fan club. Can I make more money buying the S&P 500? Well, of course, a growth stock can explode and beat any other index fund. However, we want to compare it because we are looking to see that. All right, so let's have a look. I've run this for you and I've put $10,000 into Fisker of my hard-earned money. I've put $10,000 into the S&P of my hard-earned money. And I did that in 2019. 2019. We can't go earlier than that because Fisker wasn't around, right? Publicly, right? So here we are. And we can see right now on the S&P would be up to 18 grand. Nearly doubled our money. On Fisker, we'd be down to 4 grand. Not so good. So as you can see, we'd have lost money. Now, what's important is obviously that's bound to happen. They're investing and you know, it's a bit different, right? Nevertheless, you could have made more money on the S&P over that period of time. Now, you might say, now we can catch up, now we can explode. Yeah, but if you're already down, what are you going to do? You're going to buy the dips. And before you ask, that is reinvesting the dividends as well. What we can see quite clearly looking at this chart is how much more less volatile the S&P is compared to alpha spread. We can see, sorry, not alpha spread, I beg your pardon, Fisker. We can see if we look that Fisker is very volatile to macro conditions, outside conditions, and all the rest of it. Let's look at March 2020. October, September 2020. Let's go back, March 2020. Right. Now then, this is interesting. March 2020, this is really biased actually, because March 2020, when COVID hit, when a lot of companies were collapsing, Fisker wasn't doing anything because it kind of wasn't doing anything. It was kind of not doing anything, whereas the S&P dropped. So because Fisker is literally not making anything, not growing, it's not going to go down because it isn't doing anything, right? It's just ticking along as a penny stock doing nothing, right? The S&P reacted. We want to find out if we're going to buy it, what happened there, so we can see what news drives the stock. What is it that drives people to buy Fisker? I don't know, and I'm not going to do that in this review. You'd need to go and do that. You'd also need to go and do what I always do. If I'm buying a stock, I start to make friends at the companies that I like to invest in. I like to find out what the CEO is doing, what his experience is. When I get all that information, then I can start maybe finding a position. Then for me, I would allocate X amount to a stock and then start buying on the dips and building up my allocation over time. For me, absolutely not. It's not a stock for me. I wouldn't touch it with a barge pole right now. Don't see the point. I own Tesla. I don't see the point. I'd rather buy the S&P, which is what I like to do anyway. But there you go. There's my review on Fisker. Now, if you like all the links to my social media accounts, my newsletter, the discount, the video, and all those stuff where you can get members only discount to Alpha, also my link for Alpha Spread as well. I've got a referral code, whether you're a member or a non-member, all above my head, or it's below in the description of this video. Over here, there'll be more information, there'll be other videos in the series I think you'll enjoy. And that's it. There's my review for Fisker. Go and check us out on Alpha. Scroll to the bottom, see the news section, and you will see this review on the Alpha Spread page in a few days' time to add to your information if you are looking to buy this stock. And if you're watching me for the first time on Alpha Spread, thank you very much indeed. And tune in and join us here on YouTube. Until next time, as always, take care of yourselves and each other.